FOMC. FOMC meeting is in about 10 to 11 days, and perhaps it's a good idea to have a look at the stock market and a relatively short-term outlook. Welcome to myfinancesteacher.org. So looking at the S&P 500, the general stock market, we are now 29 days into a new short-term daily cycle that started over here at the end of December. Usually these short-term daily cycles last for around a couple of months. We've seen a bit of a pullback down from the 200-day moving average. After that, on Friday, S&P tried to regain the 200-day moving average, and as the cycle is still only 29 days long, I think there is a pretty good chance that S&P will eventually break above the 200-day moving average again, and perhaps gives us another couple of pokes above those widening Bollinger Bands, which is usually a sign of a bit of a reversal perhaps coming up. That might actually take place sometime closer to that FOMC meeting, early February. By then the daily cycle will be around 41-42 days long, and assuming an average duration of around a couple of months, it will still have a couple of weeks to slide down a little bit. And also by then the intermediate cycle will get to about 111-112 days long, and usually these intermediate cycles last for around half a year or so. Although the last 3 intermediate cycles were relatively short, so perhaps the ongoing one might actually stretch a little bit to bring us back to that average duration of around half a year. Looking at this upcoming FOMC meeting, we see that the market is fully expecting the Fed to hike by only 25 basis points. The probability of that, according to the market, is 99.3%. So there isn't much flexibility within the market for any sort of hawkishness from the Fed. Hence, even though a 25 basis point hike is most likely, if together with that relatively mild hike of 0.25%, the Fed talks some relatively hawkish, with the markets perhaps breaking above this December high, that might actually create a bit of a buy the rumor, sell the news event when the market is rallying into that relatively mild 0.25% hike, followed by a decline down into the short-term daily cycle low. And as the intermediate cycle might perhaps stretch following a couple of relatively short intermediate cycles, we're likely to have perhaps a couple of more daily cycles before the intermediate cycle finishes with a cycle low. And over the next perhaps a couple of weeks, if this December high is broken, the next resistance level is from the previous intermediate cycle top around the 4300 on SPX, which by the way aligns with this 62% Fibonacci retracement of all of this bear market so far from the beginning of last year. So there are quite a few resistance zones within the next 5 to 8% gains on S&P 500. So while I had been fortunate to play a bit of a rally over here and sell half of the positions over here at the tops exactly, just due to the round number on SPY, I had subsequently been stopped out on the remaining half of the position over here, with the decline lasting for a couple of days, with a bit of a negligible profit on that remaining half. All of that, by the way, is in the model portfolio available to the members at myfinancesteacher.org. What's also available to the members is, of course, regular updates on a range of assets, including precious metals, energy, general stock market, and crypto, and my quest for interesting precious metals developers, some of which have already given us anywhere from 40 to 100% gains within around a month or so. Perhaps that's just luck, but we'll take it. Coming back to the general stock market, let's see if these scenarios agree with the market sentiment and seasonality. We see that market sentiment, the optics optimism index, has recently poked above 70, so we are getting a little bit overheated here. Hence, even if the stock market continues higher for the remainder of the short-term daily cycle, again, as I mentioned, there are several resistance levels within the next 5 to 8% gains on SPY. So the idea of approaching some sort of a top, perhaps closer to the FOMC meeting, does agree with what this optimism index is showing us, breaking above this red line at 65 and breaking above the 70 level. Next, let's move on to seasonality, which doesn't tell us much on the finer details of a daily cycle, but perhaps in terms of an intermediate cycle, it does suggest that the markets might drop after that FOMC meeting sometime into late March, with a bit of a pronounced drop over here on seasonality chart. However, that's mostly due to the pandemic drop in 2020. If you remove that year, we see that seasonality suggests that the stock markets usually continue chugging higher into May. You probably heard of sell in May and go away. That's been traditionally a relatively slow time in the markets. Hence, in summary, over the very short term, perhaps a continued uptrend into those resistance levels, into FOMC. After that, perhaps you want to be somewhat cautious. And that's a short to intermediate term. In the longer term, though, an interesting question is whether we're going to see a stronger, proper recession, say, in 2023. Let's have a look at that interesting question in one of the upcoming videos. So stay tuned. Remember to subscribe to the channel so that you don't miss our updates. Make sure to hit that like button and share the video with your friends. Have a pleasant weekend. Bye-bye.